If you're planning to retire prior to reaching age 65 when you're eligible for Medicare, the time of year that you retire matters because it can cost you a tremendous amount of money with respect to private health insurance premiums. In this example, I'm going to show you the choices that a couple has as to when they want to retire during the year. They're looking at retiring at the midpoint of the year in July or waiting to the next calendar year in January of 2026. So in this example, I'm going to use the couple John and Sally. John turned 65 at the beginning of this year. Sally turned 64 in June of this year. And so in either case, John's going to be Medicare eligible. Sally's going to have to carry some private health insurance for 6 to 12 months, depending upon what decision they end up making. This scenario is really going to be driven around how much income they have, because private health insurance on the Affordable Care Act exchanges is driven off of your adjusted gross income. So let's dig in and take a look at how this would look for both John and Sally. So in this case, they have $2.4 million of tax-deferred assets, primarily in 401k and IRAs. They also have another $200,000 in a brokerage account, and they plan to live off that $200,000 for the first couple of years of their retirement. If they choose to retire in July of 2025, their total income would be $154,000, and that would equal their adjusted gross income as well. If they decide to push out and retire in January of 2026, of course, that income drops. Their salaries would cease. The interest that they receive off of their brokerage account would still be about $5,000. I've also assumed that they would do a Roth conversion to at least eat up their standard deduction in 2026, so they can more or less tax-free be able to move some money from their taxable, tax-deferred IRAs to their tax-free Roth. We can get into that in a different video. In this case, however, I also want to make mention that at the end of 2025, the Tax Cuts and Jobs Act of 2017 sunsets. And that's what I'm assuming here. So I'm assuming that on an inflation adjusted basis, the tax brackets revert back to year 2017's tax brackets, along with, in essence, having the standard deduction. So in either case, their income is low enough where that's not going to have as much of an impact. The number that we want to take a look at here is, under that assumption, if they retire at the beginning of next year, their income, earned income for 2026 is going to be very, very low. And let's take a look at the impact on Sally's potential health insurance premiums. So if they worked to mid-year, had about $154,000 of adjusted gross income for 2025, the insurance premium for the next 12 months would be roughly $1,100 per month for a silver plan. That's over $13,000 of cash outlay that's going to come from their retirement budget. So that's a pretty big budget item heading into retirement. If they waited till January of the next year. Now, Sally only has 6 months until she becomes Medicare eligible. So she's been working on her company's plan, takes 6 months off the timeline. And in this case, because of the anticipated lower adjusted gross income in 2026, that plan premium goes from almost $1,100 to $40 a month. And that doesn't, over 6 months, it's less than $250 worth of insurance premium. So that's a pretty big savings for both of them. So in this case, all else being equal, if John and Sally are willing to work till the beginning of the next year, they can start new in the new tax year, have a much lower adjusted gross income that they can control, and lower Sally's health insurance premiums for the 6 months before her Medicare kicks in. If you liked what you saw here and you want to learn more about how you can maximize your income and reduce your taxes in retirement, visit me on my website where you can schedule a complimentary consultation where we can discuss strategies and methods for you to do so.